Defiance ETFs offer some amazing dividends, but not without risk. Do you know how to protect your investment? This video is not financial advice, nor is it a recommendation. Please do your own due diligence before investing into anything. Defiance ETFs like QQQY, JEPY, and IWMY carry two main risks. The first is the NAV erosion you typically expect from a fund paying out such high dividends every month. When a fund or company pays a dividend, that money comes out of its share price, so the more they pay, the less your shares are now worth. The other risk is the downside of the Defiance option strategy. If you're not familiar with how these ETFs work, here's a quick video explaining them. For those who have watched it already, you know there's a good chance any downward movement in the indexes likely means a red day for these funds. Here are 5 ways to hedge these ETFs. Each method gets progressively more advanced. This first method will address the NAV erosion from dividend payments, and that is to drip your dividends. That means to reinvest them back into the ETF the day they're paid out. Since the dividend is what drops the NAV per share, putting that dividend right back into the ETF maintains your total capital invested while increasing the number of shares in your portfolio. This is often referred to as the dividend snowball. Eventually, your dividends will recover all the money you've put in, so you'll essentially be playing with house money after that. The next method can address both the NAV erosion and downside risk of the strategy. Rather than reinvesting your dividends back into the same ETF, you'll buy another stock or ETF you believe is safer than this one. These would be ETFs like VOO, SPY, or SCHD, or if you pick individual stocks, something like Coca-Cola, Pepsi, or Microsoft. Those are just examples, not recommendations. This next method, which I consider intermediate level, is to buy puts. Ideally, you would buy puts against your Defiance ETFs directly when they're doing well so you can hedge for cheap. However, even if your brokerage doesn't offer options on Defiance ETFs, you can still buy a put against an ETF that owns the same index. If the market goes down and you own puts against your Defiance shares, you can just sell your shares at the strike price. If you had to buy puts against something like QQQ for the NASDAQ or SPY for the S&P, you can just sell the put at the higher premium now that it's in the money as a means of offsetting your losses. If you'd prefer not to invest additional capital, this next one might be a better fit. Instead of buying puts, if your brokerage offers options on Defiance ETFs, you can sell covered calls against your shares. The premiums will increase your income from holding the ETFs, and you can trade out early to avoid assignment. If you closed out for a profit, you keep the difference and your shares. The only potential downside to doing this on a Defiance ETF is there may not be enough interest in these options to be able to trade out of a covered call before expiration. This last method I consider advanced, not because it's hard to understand, but because your timing must be right for this to work. If you see signs of a crash coming, you can short. Shorting can either be short selling, which is borrowing shares you don't have, selling them when they're high, and buying them back after the drop to cover. The drawback of short selling is having to pay interest on the shares you borrow, and if you borrow shares of something thinly traded or an obscure ETF, those rates can be extra high since they're hard to borrow. The other method, you can call this a bonus method, which is less costly and easier to do, is to buy an inverse ETF that shorts the indexes for you. Inverse ETFs short an index like the S&P or the NASDAQ using the futures market. Their goal is to provide inverse returns of that day's activity on their respective index. For example, if the S&P moves down 1% in a day, SH, a 1x inverse ETF, would move up 1%. SDS, a 2x inverse, would move up 2%, and SPXU, a 3x inverse, would move up 3%. To short the NASDAQ this way, look at PSQ, a 1x inverse, QID, a 2x inverse, and SQQQ, a 3x inverse. If you like this video, you might also enjoy this one here on the screen. Subscribe to join the Cash Flow Club and hit the bell for notifications so you don't miss a single video.